Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
T-bill or not to T-bill? That is the question. And to discuss that topic with me, I have Fran Rudeloso and Bill Sokol, the whiz kids of Van Eck's taxable fixed income portfolio management and product management. Who better to talk about one of the biggest trends in markets today, which is the T-bill and chill trade, sitting out the market volatility in T-bills. Guys, thanks for joining.
Hey, Ed.
Thanks for having us, Ed.
Fran, I think I first learned it from you, and it hadn't dawned on me before that, you told me you were buying, I don't know, it was 3-month T-bills and just rolling it over. And this was some time ago now. And I'm like, oh yeah, why wouldn't I do that with some extra cash as rates have started to go up, I guess since March of 22, you've been chilling for a while.
Yeah. It's a way of managing your own stress for sure. But one thought, and just Bill and I had a lot of conversations about this, is like, well, there's yield back in the universe. Where's the best place to go? And we thought, well, if you want to stay at the safe side in terms of credit for a little bit, or with part of your portfolio, why not go where there's the most yield? And as once the Fed started hiking, I also thought for sure that the market was not giving them enough credibility that they would stick to their guns and continue hiking. The short end seemed to be a good place to, you could say hide out, but also take advantage of the yieldiest part of the curve.
Yeah. And it's been a good place to be for a while, for over a year now for many investors, just to kind of sit it out. And we're now at this interesting time, I think, in the market where, I don't know, there's maybe a question about continuing to kind of sit it out. I think the market seems to think that the Fed is near a pause or perhaps even a pivot. I don't know, Bill, as a product manager, how does that weigh into some of the different things that you look at and different opportunities across the product suite or new development ideas?
Well, I think a pause or a pivot, that's the expectation right now. I think this has been one of I'd say the most clearly telegraphed hiking cycle in memory. But the market has really underestimated the Fed along the whole way, I think, right? In terms of its willingness to be very aggressive. The Fed is saying, maybe another hike's on the table and that rates are going to stay high. So I think the market may continue to underestimate that. And I'd say that still continues to favor T-bills, though, right? Because it means short end rates will stay high. I think what investors also need to consider is how this impacts the curve further out, longer duration. People were talking about a pause or a pivot at the beginning of the year. At the beginning of this year, expectations were that we'd be cutting rates already. A lot of money has gone into T-bills, of course, this year, and money market funds as well. A significant amount. We've also seen a meaningful amount go into longer term bonds and intermediate core bonds, because I think a lot of investors were expecting a pause or a pivot earlier in the year and thought that might make longer term rates attractive. So I think investors just need to continue to be cautious maybe with those views of when a pause or pivot may occur, and also what the impact on longer term rates will be.
What do you guys think would be a risk to the market's outlook for a pause in the near term or a pivot? What would throw that perspective out the window?
I think it's come to be a few times this year, even though, again, as Bill said, the Fed, people just refused to listen to them the last 18 months, or a lot of people did, and were convinced that they would be, they were going to break something sooner or more significantly than they have already, and would be forced to pivot because the economy would tumble, would be the most likely scenario. So that's still something that could happen, that could force out a harder pivot than we're thinking. But what's the risk of the Fed having to hike more or stay higher for even longer? U.S. growth continues to surprise to the upside, and that's a happy story. That means, eventually you'd be, maybe finding some bargains in equity and other risk markets and moving some more of that T-bill cash out there. But you wouldn't be wanting to move out duration. Of course, the other risk is the inflation story. Yes, the Fed has gotten headline inflation down, or headline inflation has come down, Who's responsible for that? Actually difficult to say. But if that does not get below 3% at least, or spikes back up for a variety of reasons, the Fed has said that they're data dependent, and so that data could force their hand again. One thing they have me convinced, never convinced they know exactly what they're doing, but one thing they have me convinced is they're responding to inflation data.
Yeah, and remember, they have a dual mandate, right? So inflation's obviously the big story these days, and we all know what their target is. But if we continue to see strong jobs numbers, I think it gives them confidence to maybe raise rates more, but certainly to keep rates higher for longer. And it seems like they're more comfortable to overshoot and, slow down growth than to cut rates prematurely. I don't think they're going to do that.
All right, so let's play out a couple different scenarios. And let's first off look at a scenario where the end for rate hikes is near. What does that mean? What are the opportunities or potential opportunities and options for investors? Is that a call for equities, go all in, or what do you think?
In my opinion, right now, these scenarios are not favorable actually for risk assets generally. Because I see two things playing out. One is you're higher for longer, and every day that you're higher for longer is not a good day if you're a borrower, maybe a low quality borrower, right, borrowing at high rates. Generally speaking, that's not also great for growth assets, right? Just the math of discounting cash flows. The other scenario is when you have the pivot and something breaks, and that probably means you're going to see a big sell-off, and that's also not great. So I think it really warrants being cautious right now, being higher in quality, being in a senior position as well, versus...
You mean in the capital structure?
In the capital
senior
structure.
Position? Yeah, right.
Yeah, I hate to agree, but I do.
That's so boring, Fran. Come on.
I know, but
we're two bond people. We're very pessimistic.
Exactly, but it's up in quality makes a lot of sense, and you could still be up in quality in the corporate debt market and structured credit in a lot of ways, and be earning more attractive yields than say you're just getting on T-bills. So you're going out the risk curve a little bit, a little less liquid, a little bit of credit exposure, but not going way down the curve and reaching for yield. And the bottom of the barrel has already rallied more than the top of the barrel this year anyway, in terms of credit, meaning triple C spreads have tightened more than spreads on the rest of the credit spectrum. And those have been, there's not a great time to be reaching down for risk that way. And no, we're not equities guys, but I know so much of the leadership this year has been the Magnificent Seven. If you look outside of there, maybe valuations aren't ridiculously unattractive in equities. But as Bill said, I think you maybe wait for an event. And that's part of the stay in the short end, gives you a chance to roll out without a lot of capital risk and add equities more opportunistically.
Yeah, I feel like we'll be at elevated levels for a while. I don't feel like if there is a pause, we'll see a major pivot unless something really does break. And you're getting great T-bill rates right now, and you could sit that out for a while, right?
Yeah, I mean, I think it's totally rational, right? Right now, you're not taking equity risk, credit risk, duration risk, it being in short-term T-bills. So yes, you can get some pickup by going into other areas of fixed income and get that spread, but it makes sense to have some of your portfolio in something like T-bills right now.
What do you guys think about money market funds? I mean, it seems like a real easy way of just getting a little bit higher yield, and as opposed to trying to trade the T-bills yourself.
I wouldn't say morally opposed, but economically opposed to paying the fees, at least the money market funds available to most of us retail investors. And without a lot of work, you can earn higher yields through T-bills. And look, Bill and I have talked a lot about some of the other options out there, and maybe let Bill hit on a couple of those in terms of shorter duration, yield enhanced with options out there with lower fees than money market funds.
Yeah, I mean, money market funds, I mean, there's a convenience to it, right? I mean, it's in probably your brokerage account, and probably it's your broker's money market fund, and they put you in, and there's a lot of convenience to it. But I think the fees, as Fran mentioned, can be high. I think it's like average over 40 basis points, and even more if you don't have access to these institutional share classes. That could be a justification for looking at things like Treasury Direct. I mean, there's inconvenience to that and maybe a learning curve. Personally, I'm a pretty lazy investor, so I like ETFs, and there's just so many ETFs out there that are very low cost. You can pick where you want to be, 3-month, 6-month, 1-year T-bills, and then you get the sort of convenience and the benefits of an ETF as well. And then there's other options, as Fran mentioned. I mean, if you wanted to move a little bit further out the risk curve, take a little bit of, get some spread above the risk-free rate, but stay ultra short. I mean, there are options.
I think it really depends on the investor ultimately, right? What their needs are and whatever their goals are. I mean, so you're probably going to see investors like myself probably doing a little bit of Treasury bills, 1 and 3 month, just kind of rolling it over, kind of waiting out the market. Maybe I need some longer term. Maybe I want some additional growth or additional higher yield, but it takes on a little risk. So I sprinkle in a little bit of CLOs or something other than that. I think too often, these discussions that you see on the media about these topics, it's so binary. It's like buy T-bills or not. So I think investors should really think about what they're trying to accomplish, kind of map that out.
You're also hitting on diversification being really one of the best risk management tools out there for investors. So even within your relatively safe fixed income lineup, diversifying a bit, adding some, higher yield stuff because compounding is going to work in your favor there. But not putting all your eggs in one basket.
Bill, you mentioned Treasury Direct before. I was kind of surprised because, I've been in the industry over 20 years or so, and I had never really bought a bond, but I was also surprised to see on, watching some pundits on CNBC who talked about buying a bond via Treasury Direct for the first time or buying a Treasury bill. And maybe it's a combination of age and income need versus the right opportunity, the right environment with rising rates to take advantage of that. But I don't know, were you guys surprised at how many people didn't know how to buy a Treasury bill or even know about Treasury Direct for that matter?
I might be more surprised that as a market, we haven't made it easier for people to buy bonds, just make the pricing and yield information more clear. I feel as if it should all be made easier. As Bill said, I mean, look, maybe this is, tucking Van Eck's book, but that's what ETFs are just such a great solution for individual investors because I think it's a much easier way of accessing all of these markets. That being said, I'm not that surprised that many people haven't accessed these markets, although a little bit surprised that fewer of us financial professionals are not there yet.
I mean, I think overall, all the talk about T-bills and Treasury Direct, I mean, it's probably a good thing being a fixed income investor over the last few years has been kind of boring. I mean, rates were so low, you couldn't earn anything. And now maybe it means more people are taking a look. And I think that's a good thing. I think it's just a much more interesting time to be a fixed income investor with yields where they are. And that includes T-bills and includes other fixed income asset classes. So maybe it's allowing more investors to learn about bonds and how they work, what the risks are.
I'm kind of a geek, so I like to manage that myself. I know a lot of people don't want to manage tracking when that T-bill matures and getting those funds and reinvesting it and mapping out that calendar date and when money's coming in. For me, I'm finding that kind of fun. Well, Fran, it's your job, so maybe it's not as fun for you anymore. And you trade more exotic things, but
as you both kind of said, though, it's getting a lot more fun than it was for about 15 years, or at least for 13 years. So yeah, bonds are fun again.
All right. So as I just to kind of wrap up this mini pod, if you will, I'm going to get your quick take. I don't know what the alternative lingo is. T-bill and chill or not? Yeah, just in a general sense. I know we talked about you probably need some diversification, but I don't know, T-bill and chill. I'm a chill with T-bills. Bill?
I think I'm T-bill and diversify. It's not as catchy, but I mean, there are places to get better yields, and I think you have to be selective. But I think there's a case for for both, right? I mean, within a portfolio.
It's a good point.
It just reminds me of the old joke, like, why do you rob a bank? It's where the money is. We said it earlier, like go where there is yield. That does mean the front end. To me, that doesn't mean just bells. It means there's a lot of relatively safe instruments and asset classes that take advantage of front end yields, but add a spread to it. And we talked about floating rate notes and CLOs. Those things are really exciting for me. As you both said, like interest rates normalizing, ultimately a good thing, and there'll be opportunities throughout the curve. Personally, I don't think we've gotten there yet. I guess not just T-bill and chill, go where the yield is.
I agree with Fran. Like, I think this is going to continue to play out. It's not done. The normalization, this hiking we've seen, remember, this is happening alongside quantitative tightening and other things the Fed is doing. So I just think we're going to see more volatility in fixed income, well, across the markets in general, but that is going to produce other opportunities throughout the whole market. I mean, again, it could be painful at times. There's going to be repricing, and volatility will provide opportunities.
Awesome. So then I'm going to T-bill and chill until I can rally into a new opportunity.
There you go.
Guys, this is awesome. Thanks for the quick chat on T-bills and the current state of the market. And hopefully we can do it again soon.
Thanks, Ed.
Thanks, Ed.
And thank you for tuning in to another episode of Trends with Benefits.